Investments in securities are subject to market risks. Read all related documents carefully before investing.
Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 8th of May, and the market came back with a vengeance. We were thinking that the previous session on Friday was the start of a leg down, but it doesn't seem like that yet. The market recovered most of the ground from Friday, and this is how Nifty was looking. So Nifty closed whisker above where it closed on Thursday, and Friday being that funny red candle you can see here, which kind of was a spinning top, but it didn't really work out, and the market is back up again. Now market is well above most of these resistances. It's on its way for this logical pattern completion for IHNS. So there is no reason to believe that market comes down immediately unless we break below Friday's low, which is now the critical point to watch out for on the index. The market makeup extremely positive. You can see a lot of green on the market today. So Bajaj Finance, Bajaj Finserv, both up. Kotak Bank, Axis Bank, IndusInd Bank up 5%. HCL Tech, Infosys, TCS up. Just look at the autos. Tata Motors up 5%. Maruti and Mahindra up 1.5%. Bajaj Auto 2%. Power Grid, NTPC, that pack is up. ONGC up 3%. Reliance up 1.2%. Levers ITC also up. So I would say, a very good day overall. No concerns on that. In terms of sectoral overview, 1.8% on the auto segment, auto sector, private banking, real estate, public sector enterprise, infra, commodities, all doing quite well. PSU banks was the only segment which did some profit booking. There were some results of Bank of India and Indian Bank. Market smashed those stocks a bit. Canara Bank was the one that which stayed quite good even after the result. So all in all, still a continuation of what was happening in the past couple of weeks, and a build back of where we were in terms of Friday close. Mid cap index solidly up, brushing aside this entire corrective Friday move. Uh, Again, heading towards an all-time high within a couple of percent. Small caps is one place where some trend line resistance may be there, and it is sort of consolidating here for the last three sessions. A big breakout will come once this is clear. So that is something that one can look for. But we've had a singular run since the bottom. So how long this will stretch is anybody's game. Even in this previous moves up, there were 4 5 sessions, 3 4 sessions which were of consolidation here. We need something like that to have this continuity going on. Nifty Bank was an inside day. So previous candle was a very large candle from 42,600 to 43,600, almost 1,000 points there. So today's candle was within that candle. It was an inside day. It did not breach the previous high or the week's high. So from that perspective, Bank Nifty was not as strong as the rest of the market. And given the fact that we will continue to believe that Bank Nifty, uh, front runs the market, we want to see this go up in the next session to sort of ensure that and to be more confident that yes, the market is continuing to go up. Few sectors which are looking good. So Nifty public sector enterprise, this segment which comprises of all these stocks like NTPC, Coal India, Oil India, and several other names, few of which I had mentioned in a tweet recently. This particular index is breaking out after 15 years. So this move which was there 2003 to 2008, where this index went up like 5x, Uh, this has been in a sideways mode since the last 15 years, between 4700 and 2000, and it has had several of these moves up and down, and only now after 15 years is the all time high been reached, and now it has a chance of really breaking out hard for the next many years. So this may be a emerging trend that public sector enterprises will lead the market in the coming times. Autos is somewhat of a similar story, though not all that long. But auto sector also has been in a sideways mode since the last many months, and now it is breaking out versus a lot of other sectors which are nowhere near the all-time high. So this tells us which sectors are gaining momentum and which sectors are likely to go forward fast. So this is clearly a breakout at an all-time high, and that's why you can see most of the auto stocks also doing quite well. Real estate is another sector which has been in place since 2016. So it had a run from 150 to about 350 in 2016 to 18. Then it consolidated and came down to about 175, 200 after the COVID crash. And from 200, it went to 550. So almost 1.5 times higher, 250% up. And sorry, 150% up, and it is now beginning to start a new journey upwards. It seems it's a nice flag pattern. It may have a long runway here to go through for the next maybe 6 months, 1 year, or something like that. So this is something that I expect, unless this breaks down. If we are able to cross this 480 kind of resistance, I think the path is clear for a new high on this one. Stock of the day, Apar Industries. It came out with some great results. The only reason I'm highlighting it here is that in the last 1 year, it is up almost 5x. We have this in several of our portfolios. That's a disclaimer. But what I want to emphasize here is that despite the run up, even prior to this date of last 1 year, it was still running up, and there was disbelief in the market that how can it continue to go up with the market going sideways. But this is what the entire bhava bhagwan che, the BBC principle, is that the market is telling you that the stock is going to do well, and that's what it has done. Yes, there were some dips here. In fact, in one of our strategies, we got out in this dip, but then we got in again later on. But essentially, the point being that the prices tell us that something is brewing in the stock, something is happening, it is going to a new level of valuation. um, the price action precedes the news, and that's what we are seeing. The results are coming now, but the price action has been there for a year now, even more than that. So this is something that non-discretionary ways of investing, if you do in momentum investing kind of fashion, it helps you to identify stocks much ahead of when the news will tell you, and the news is usually late. So another mini topic of the day: gold versus gold stock. So a lot of times people are saying, why should I buy gold? Let me buy gold stocks instead. So there could be gold mining stocks, there could be gold loan stocks, anything to do with the industry. So when gold prices go up, gold mining stocks do very well. That is the sort of expectation, because you have unmined asset with you. So if gold is going up, then the entire asset that you have with you, which is yet to be mined over next 10, 20 years, will be valued upwards along with gold. And then, of course, gold loan companies also expect that as gold prices go up, more and more people may resort to taking gold loans, and their business will do very well. And to some extent, both these theses are correct. But what we have seen is that the purpose of buying gold versus purpose of buying gold stocks is very different. So always remember that why are you buying gold? You're buying gold to act as a hedge, to protect you as an insurance against all your other assets, against your local currency, against your own government, against your own country doing anything funny. you need that security with you, right? So that is one thing that you need to be clear why you're buying gold and how you're going to buy gold. Now, the most beautiful aspect of having gold is that gold by itself, if you're holding a gold bar, it does not have any counterparty. I mean, that is not a IOU from somebody. If you're holding a 500 rupee note or a 2000 rupee note, it is just a piece of paper. It only means that the central bank is saying that if you present this paper, then they owe you certain value of that paper. But it's a IOU. I mean, it is not uh, value itself, just because everybody else believes it that it is value. That is why you are able to exchange it for goods and services. The second part is that, let's say you have demat stocks. So your demat stock is sitting with with a DP, a depository participant. God forbid if something happens in a DP or in the DP system, you basically have no resort. You basically have nothing in your hand. The same thing is with bank FD also. You have your money in the bank may go belly up. The government usually bank guarantees or guarantees backstops all the deposits, but there may come a situation where the government may not be able to do it, right? So that is again counterparty risk. So I'm trying to explain you what is counterparty risk. Anything that involves another third party to make sure that you have your asset is a third party risk, is a counterparty risk. Even land, because the land record is determined by the government. If the land record says ABC is the owner of the land, only then that land belongs to you, otherwise it is not. So gold is the only asset in the world. Of course other metals also, but because they are not valued as much, you don't say that, I'm holding a bar of copper or iron, and that is something that I should store. But the gold is the only asset which does not have counterparty risk. So the best way to buy gold, of course, is pure physical gold. There is no two ways about it. Now it has its own issues about security, about purity, where to buy, where to sell, so on and so forth. So the next best way is sovereign gold bonds. So the government is buying gold on your behalf. At least that's what you're assuming. And of course there is counterparty risk, but at least the counterparty is a sovereign. Counterparty is not an XYZ third party in the market. So from that perspective, that is a step down, but it is still a reasonable step down, that at least you have the government which is backstopping your sovereign gold bond. If the government goes bust, then the paper in your hand is also worth nothing. Nothing is worth anything then. Third way, of course, is to go for a gold ETF, where private asset management companies will provide you with a IOU, and it's tradable on the exchange, and they will keep that physical gold backing with them, which may or may not be audited, but one would assume that it is being audited. Then there are gold mutual funds, digital gold, all other variations, where more and more as you go down that chain, the efficiency of buy and sell and the margins keep increasing for the intermediaries. So this is a small sort of deviation from where I was, but essentially gold stocks probably come at the end of this chain, where while there is some linkage to gold, but gold stocks can be in their own world at times, and I'll show you some examples. So this is Manapuram Finance. There are two major gold companies getting traded: Manapura Finance and Muthoot Finance. Both are great gold loan companies, um, but they have their own issues from time to time. So last year or so, I mean, Manappuram has recovered slightly in the last day. I think this chart was made a couple of days back, but it's down 20% in just 3 days, because there were some local issues with the company. Some raid was there or something like that. Gold is meanwhile up 17% in the same period, while it is down 8%. So short term, There has been a mismatch over a 10-12 year period. Again, while the black line representing Manappuram Finance had gone up several 100%, but recently in the last year and a half, it has crashed down, and now it is exactly replicating the returns of gold over this period of almost 12 years. So you would have seen all this volatility, but still made only gold returns. This is just a matter of chance that the returns are same at this point of time. Another example is Muthoot Finance. In the last 5 or 6 months, while gold is up 10%, Muthoot Finance is down 3%. In the short term, there has been a deviation from the gold price, but in the long term, Muthoot Finance over the last 10-12 years has done really well. It is up 500%, whereas gold in INR has done only 140%. So from that perspective, Muthoot Finance has done extremely well versus gold price. But as I said, in the last year and a half, that also is down 30-40%, whereas gold is up in that period. So very little sort of uh, direct proportionate relationship there. And to give you a international example also, the orange line is the gold price in US dollars. Since the turn of the decade, it is up nearly 400%. But the top two gold companies, Barrick Gold, in which Warren Buffett also invested some time ago, but he sold off, and Newmont Corporation, both are supposedly, very premier gold mining companies, have underperformed gold by a big margin over these last 2 decades. So from that perspective, because gold mining companies or gold loan companies have issues of their own. They could be stuck in their own debt. They could have some shareholder issues. They could have some liquidity issues. So it is not just the gold price that they're tracking. There are so many other things happening. There's competition in the industry. Somebody may be, acquiring one another. Somebody may be having some labor issues. Some country issues may happen. Some mining ban may happen. They may have some mines in South Africa, and they may get, banned out. So a lot of issues can happen which are not related to gold price as such in a stock which is related to gold, and hence there is a one should have a sort of buy gold mining or gold loan companies with a pinch of salt, that this may or may not replicate the growth of gold. And the whole idea in my view, as I mentioned, is that if you want to hedge and if you want it as an insurance, if market liquidities really goes bad, let's say, we have a 2008 1929 kind of scenario, then gold loan or gold mining companies will also go down because they will be burdened or saddled with debt, and they will not be able to perform there. Yeah, because when market liquidity goes out, it will go out of every stock regardless of what intrinsic value it may have. So from that perspective, I think it's very essential that you diversify your risk away from equity by using physical gold, by using sovereign gold bonds, etc., so that there is a demarcation from your demat account, there is demarcation from your market exposure to equity, and then you have something, which you can really fall back upon if heavens were to fall. This is all I have for today's session. But just to distill these insights, real gold may remain stable, but gold stocks may be volatile. Gold stocks may beat real gold over time, but may have underperformance also because of the volatility. You may consider sovereign gold bonds if you want to invest in gold, unless you are able to do in physical, which is the best format. And never ignore the counterparty risk angle. I think that is the most important thing. People who were driven away from their homes at the time of partition, for instance, whatever they could grab out of their gold and run to the other country, they were able to re-establish their lives using that. So never ignore the counterparty risk angle. Thank you so much for watching this, and I'll see you in the next one. Bye.